The New Zealand dollar is one of the more interesting currencies in the Forex market, and understanding what drives it can make you a sharper trader across the board. The NZD USD pair tells you how many US dollars it takes to buy one New Zealand dollar. If the rate is sitting at 0.600, one Kiwi, that is the nickname traders use for the New Zealand dollar, after the country's national bird, is worth 60 US cents. Simple enough. But knowing the price and understanding what moves it are two very different things. New Zealand runs a relatively small economy built heavily on commodity exports. Dairy, meat, wool, timber. These are the backbone of the country's export sector, and they are all priced in US dollars on global markets. When demand for those goods is strong and prices are rising, the Kiwi tends to strengthen. When commodity prices fall, the New Zealand dollar usually comes under pressure. That is the core relationship traders need to internalize. On the other side of this pair sits the US dollar, the world's dominant reserve currency, used in the majority of global trade. Its strength is shaped by Federal Reserve interest rate decisions, inflation data, employment figures, and broader growth expectations. When the Fed raises rates aggressively, the dollar strengthens and NZD/USD tends to fall. China matters here too. New Zealand's close trade relationship with China means that strong Chinese economic growth tends to lift demand for Kiwi exports, and that feeds through to a stronger NZD. There is another layer worth understanding. The New Zealand dollar is what analysts call a risk-on currency. When global confidence is high and investors are willing to take on risk, they tend to buy currencies like the Kiwi. When fear takes hold, a financial shock, a geopolitical flare-up, money flows into safe haven assets like the US dollar, and NZD/US typically drops. That dynamic means you need to watch global macro conditions, not just New Zealand and US news. On timing, NZD/USD is most active during the Asian session, when Wellington and Sydney markets open, and New Zealand data tends to drop. Liquidity picks up again during the New York session, around US data releases. Those are the windows where the pair tends to move with purpose. If you are approaching this pair for the first time, the most valuable thing you can do before committing real capital is practice. A demo account lets you observe how the pair behaves across different market conditions without any financial risk. Trading is genuinely difficult, and most retail traders lose money, especially early on. Protect your capital while you are learning. The one habit that separates traders who last from those who do not is consistent risk management. Set your stop loss before you enter, and never risk more than a small portion of your account on a single trade.